All right, time to get our hands dirty. As we dig into these tools, you're going to see something really interesting emerge. Valuing a startup isn't just one thing. It's this incredible blend of art and science. Let's start with the art. This is the Burkes method. It's pretty much perfect for those super early stage companies. We're talking pre-revenue, sometimes even pre-product. It's basically just a great idea and a solid team. This is a huge favorite for angel investors. So, how does it work? It's beautifully simple. An investor looks at these 5 key areas and assigns a value to each one, often up to $500,000 apiece. See? There are no complex spreadsheets here. It's all about making a judgment call on the quality of the idea, whether there's a prototype, and maybe most importantly, how good the team is. Okay, now let's do a complete 180 and go from the art to the science. This is the discounted cash flow method, or DCF for short. If you've ever taken a finance class, this one will probably look familiar. The whole idea here is purely mathematical. You start by trying to predict all the money the company is going to make over the next, say, 5 or 10 years. Then, and this is the key part, you apply something called a discount rate. That's just a fancy way of saying that money in the future is worth less than money today, especially when there's a ton of risk. Once you've done that, you add it all up to find out what all those future earnings are worth right now. It's an attempt to get a super precise answer. But here's the big problem. For a startup that's just getting off the ground, trying to predict its cash flow 5 years from now, it's basically fortune telling. The science is only as good as the guesses you put into it, and for a startup, those guesses are really, really hard to make. So what if you could take that art of thinking about different futures and blend it with the science of a financial model? Well, that's where the First Chicago method comes in. It's a really cool hybrid approach. Remember those 3 scenarios we talked about? Best case, base case, and worst case? This method runs a full valuation for each of them. Then you take a guess at the probability of each one actually happening. You multiply it all out, and you get a single, weighted average valuation that already has all that uncertainty baked right into it. Pretty clever, right? And to finish filling up our toolbox, here are 2 more heavy hitters. The venture capital method is all about the exit. An investor says, okay, I need to make 10 times my money on this. If I think it can sell for $1 billion in 7 years, what does it need to be worth today? You literally work backward. Then you have comparable analysis, which is about looking around you. You value a startup by checking out what similar, more mature companies are worth in the public market or what they've sold for. So we've looked at all these methods, all these scenarios, all this art and science. But how do you get from all of that to the one number that ends up in the headlines? How does it actually happen? And honestly, this is the most important thing to understand. A startup's valuation isn't just spit out by a spreadsheet. It's a negotiation. It's a story. The founder tells a powerful, compelling story about the future they're going to build. All those methods we just talked about, they're the evidence. They're the data points you use to make that story believable. The final number is the middle ground where the founder's vision and the investor's conviction finally meet. So, at the end of the day, a valuation is so much more than just a number. It's a narrative about what's possible. It's a bet on a team and their ability to turn an idea into reality. It's a story about the future, just backed up with some analysis. And that really just leaves us with one final question to think about. What story is your idea worth?